Dear students, welcome to my channel, Dr. V.R. Pudili, Professor of Management and Economics. In this video, I am dealing with short-term sources of finance. Short-term sources of finance. Short-term sources of finance are defined as sources of credit or loan facility extended to businesses or enterprises for a period of less than 1 year. These are also known as sources of working capital financing. Short-term sources of finance help enterprises to bridge the gap between income and expenses in the short run. Short-term sources of finance help the enterprises to manage their current liabilities such as payment of salaries and wages, payments to raw materials, and payments of bills. Short-term sources of finance ensure the sufficient liquidity in the enterprise and facilitate the smooth functioning of the enterprise's day-to-day activities. Short-term sources of finance can be divided into 7 types. They are 1. Trade credit, 2. Bank credit, 3. Customer advances, 4. Installment credit, 5. Commercial paper, 6. Certificate of deposit, and 7. Factoring. Bank credit can be divided into 6 types. They are 1. Cash credit loan, 2. Overdraft, 3. Letter of credit or LOC, 4. Bill discounting or hundies, 5. Demand loans, and 6. Short-term loans. Let us explain short-term sources of finance in detail. Trade credit. Trade credit refers to the credit extended by the supplier of goods and services in the normal course of business of the firm. According to trade practices, cash is not paid immediately for purchases but after an agreed period of time. Thus, deferral of payment represents a source of finance for credit purchases. 2. Bank credit. Bank credit is the primary institutional short-term source of finance. It is of different types, including cash credit loan, overdraft, letter of credit, bill discounting, demand loan, and short-term loan. Let us deal with different types of bank credit in detail. 1. Cash credit loan. Under cash credit system, a business organization is sanctioned a credit limit up to which it can borrow from the bank. The limit depends upon the credit worthiness of the business and quantity of funds required for it. The actual utilization of the credit limit depends upon the withdrawing power of the business from time to time. The withdrawing power of the business in a particular period of time depends on the total value of the stock of raw materials, semi-finished goods, finished goods, and the amount of accounts receivable that the business holds. For this purpose, The business organization need to submit a statement reflecting its withdrawing power. Interest is charged on the actual amount utilized by the business, not on the actual CC limit. The minimum commitment charges may be there on unutilized part. This form of bank credit is most attractive. 2. Overdraft. Bank overdraft is a temporary arrangement of the business organization with the bank that allows to overdraw from its current account or to withdraw over and above its CC limit up to certain extent. The overdraft facility is granted against securities of stock and marketable securities. The rate of interest charged on overdraft is comparatively much higher than the rate of interest on bank deposits. 3. Bill discounting or hundies. Bill of exchange or hundi is a document or bill created by the seller of the goods and signed by the buyer after taking delivery of goods, promising to pay the bill within the credit period granted by seller to buyer. These hundies or bills of exchange can be submitted by the seller to the bank before credit period and get them discounted for getting funds. Banks usually give less amounts than the maturity value of the bills. Bank later collects full bill value from the buyer of the goods. Bill discounting is a source of finance for seller of goods against credit. 4. Letter of credit. The purchaser of goods on credit obtains a letter of credit LOC from bank. The purchaser submits LOC to supplier of goods and get goods on credit. The bank undertakes the responsibility to make payment to the supplier in case the buyer fails to meet his obligations. Bank only assumes risk. Credit is provided by the supplier. Bank charges fees on LOC. 5. Demand loans. Demand loans granted by a bank are those loans which can be recalled on demand by the bank at any time. These loans are generally granted to stockbrokers. 6. Short-term loans. Short-term loans are the term loans provided by banks for a period ranging from 1 year to 3 years against different modes of securities including hypothecation, pledge, lien, mortgage and charge. The third short-term source of finance is customer advances. Manufacturers or the suppliers sometimes may insist upon advance payments by the customers, particularly in case of special orders or big orders. The customer advance may be part of the price or full price of the products ordered. This is an interest-free source of finance. The period of such credit depends upon the time taken to deliver the goods. The fourth short-term source of finance is installment credit. Installment credit is another source of short-term financing in which the borrowed amount is paid in equal installments with interest. It is also called installment plan or hire purchase plan. Installment credit is granted to the business organization by the suppliers on the assurance that the repayment would be done in fixed installment at regular intervals of time. It is mostly used to acquire long-term assets. The fifth short-term source of finance is commercial paper. Commercial paper is a short-term financing instrument used by the business organization with high credit rating to raise money from the market. It is an unsecured promissory note which the business organization offers to the investors either directly or indirectly through the dealers. Commercial papers are generally sold by large business organizations which have strong goodwill in the market. The sixth short-term source of finance is certificate of deposit. Certificate of deposit is a tradable bank deposit or a marketable receipt of funds deposited in a bank for a fixed period at a specified rate of interest. Business organizations can sell their certificate of deposits to get funds before their maturity period. The seventh short-term source of finance is factoring. Factoring involves outright sale of receivables at a discount to a factor for obtaining funds. Dear students, in this video, we learned about short-term source of finance. Thank you.